Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today we're going to be covering how to find a stock's ex-dividend date days, weeks, or months in advance. Now, this is part of my investing playlist. My other video covered Y charts, how to access it from my website, and then how to use it in order to pre-screen some stocks very quickly. So in today's video, we're going to be using Dividend.com in order to find some stocks with ex-dividends in the next week, and then we're going to screen them very quickly in order to kind of get a visual screening process done where we can then deep dive into the select few that remain into their 10Ks and their balance sheets and such. So we're only going to go as far as getting about at least like 5 stocks to kind of pre-screen through, and then we'll use Y charts to kind of see which of those could be a good potential buy right now. So of course, if you are brand new to my channel, I do make stock market, investment, and financial videos weekly, so do consider subscribing for future financial videos. And of course, if you do like the video, hit the like button below. I really appreciate it. So let's go ahead and get started. The very first thing you want to do is head over to Dividend.com. This website is an amazing site for all things dividend related. Now, what you want to do is you want to click on ex-dividend dates. Now, depending on the dates that you're looking for, you can go ahead and change the dates here. So I'm going to be looking for a stock with an ex-dividend date. We'll go ahead and say, tomorrow is, what's today's date? Today is the 7th. So I'm going to go ahead and look for a stock on the 9th so I can make my purchase on Thursday, today, when I'm releasing this video, and then in between there in the end of the month. Now, I don't want to pick up anything besides common shares. You can leave these selected if you would like, but I normally buy common share stocks or sometimes some REITs. But for now, I'm going to go ahead and select common shares. Now I'm going to hit search. Now, if you have a logon for this website, you're going to be able to see the DARS ratings. Now, that's pretty important because the next thing I'm going to be doing is sorting by the DARS rating. Now, what is the DARS rating? Let's go ahead and flip over here and I will show you. So the DARS, it's the Dividend Advantage Rating System that Dividend.com screens these stocks by. They talk about their relative strength, whether they're trading above its 50-day and 200-day moving averages. It talks about overall yield attractiveness. It doesn't want to yield over 10%. These are risky. And it doesn't want to yield under 1% because these are not very beneficial for long-term investors. It also talks about dividend reliability. Do these stocks, the higher the rating, the better the stock has been paying out dividends year over year over year and increasing their dividends. Dividend uptrend, are they increasing their dividends regularly by say 5 to 10%, or is it a little bit less? That would cause them to get rated a little bit lower on the DARS. Then we have earnings growth. How are they going to be projecting for the next 4 quarters? Is it going to be projected as positive or negative? And then of course how to interpret it. So anything between a 3.75 and a 5 is considered highly recommended right now. Recommended is 3.5 to 3.7 and neutral is 2.5 to 3.4. Now I like to pick up stocks when I do my 5 stocks with ex-dividends next week. I will normally include all the stocks between 3.4 and above. That'll give me neutral to recommended to highly recommended. So those are the ones that we're going to be taking a look at, and then of course anything between 0 and 2.4 is a void for now. Now let's flip over here and take a look what stocks we have next week. We can automatically see we have a few stocks with ratings of 3.9. So 3.9 on the scale would be highly recommended. So we have 1, 2, 3, 4, 5. So that's perfect. We wanted 5 stocks. Let's go ahead and enter these stocks into our Y charts. So on the left hand side here, if you don't know how to access Y charts, there'll be a link in the top right corner. I go ahead and show you how I access Y charts. You guys can use that link on my website in order to access it for free, and it already comes preloaded with all these financial metrics that I use to measure the stock by. Just very quickly for my screening process. So I'll enter SJW, MMM, UTX, J&J, BOH. Let's go ahead and enter the 3.8 one as well, which is GWW. Now we do have a few others that are 3.5. 3.5 on this scale is recommended. So why don't we include those 3.5s in as well? That just gives us some more stuff to play with there. So we have BOH, GWW, WTR, Target. Look at that, Target's up in there. And LMT, Lockheed Martin. So there we go. So now we have found some stocks. We can see here automatically on the right hand side that they are rated. They have the ex-dividend date here showing by the 9th. So the 9th is this Friday. So technically I could buy SJW Corp on Thursday and pick it up for the ex-dividend date on Friday. And if it did go positive, I could then sell it off, collect my dividend on the 1st of March. And if I was trading this inside of a Roth IRA, as long as I sold it positive, I wouldn't lose anything. I wouldn't have to worry about paying capital appreciation, and the dividends and capital appreciation will be tax-free. So let's go ahead, and we are done now using Dividend.com. Now over here at Y charts, now I go ahead and deselect most of these. Now the process that I usually look for to look for stocks that are undervalued is I want to look for a yield that's trading over the price right now. So right now we've gone down as around mid time of January or so. You can see that this stock was trading up very nicely throughout 2017. And going into January 2018, this stock has came down. So this could be a utility company. Actually, before we do this process, let's just quickly, so if you click on these links, that's what's great over here. You can click on these links here and you can open them in a new tab and just quickly kind of see what stocks are we going to be investigating into. And I did add those 3.5. So SJW, it's a water utility. So yes, utilities are getting hit hard right now with increasing rates, interest rates. That means that all their debt that they're taking out in order to fund their new projects or such, they're going to have to pay that back at a higher cost, much higher cost. Triple M is a conglomerates general, and as you take a look at these, take a look at the dividend growth. That's why they're rated so high. They have a very nice yield. They have a lot of dividend growth. Then the last time that they increased their dividend here, they had special dividend payouts. They increased their dividend by, where is their, okay, so we can see here that they increase it from 21 cents to 28 cents. Now, just kind of busting out my handy dandy calculator, 21.75. Actually, we're taking the current one, which is 28, subtracting the past one, which is 21.75, and dividing by the past one, which is 21.75, multiply it by 100, and that gives us a difference, an increase of 28.73. So that is a very nice dividend. That's why it is considered a 3.9 rated company. Lots of years of increasing dividend growth. Here we have Triple M, 59 years, UTX, 6 years, 2.12 yield, and so on. Johnson & Johnson, drug manufacturer, 55 years of dividend. We have Bank of Hawaii, bank company doing really well during with increased rates. Banks are giving out loans and they're going to get that money back. GWW, it's electric wholesale. They have 46 years of dividends. WTR, this is water utilities. This one seems to be doing semi-positive. 10 years of dividend growth. We have Target, 50 years. Lockheed Martin, 15 years. And that is basically the ones that we covered there. So you can see that these, you can kind of see a little bit why these are rated so much. So automatically on the website, you can see the current yield, their payout ratio. I consider anything underneath 60 a pretty good payout ratio. Anything over 10 has paid out through the last recession, because the last recession was back in May of 2008. So 10 years ago would put us, as long as they've been paying out dividend growth for 10 years, they've paid out through that recession. And if they've been paying out for 10 years or longer, they've been paying out through multiple recessions. Here we have the upcoming dividend payouts. So this is a clock ticking down, meaning that they're going to be paying out, or their ex-dividend date is coming out in 1 day, 38 minutes, and 20 seconds. Down here you can see when their next ex-dividend date is, their record date, and their pay date, and it's a regular scheduled payout, not a special. Going a little bit down, their annual growth for 2017 for their dividend was around 7.4, and they actually paid a special dividend out there. Now it captured the last, the prior dividend increase here, 0.225 2025 to 0.2175. That was an increase of 7% but they did increase it by our number here of 28% just recently. So, and then it kind of gives you a synopsis of what the company is about and some related companies. So quite a bit of information very quickly by using Dividend.com. Now jumping back over to fundamentals. Again, I'm looking for a yield over price because that would be considered a good company, but at the same time I know this is the utility company. With increased rates, this could be very risky as they're taking out debt and having to pay that debt back if they're already in debt. So while this is currently trading at a yield over price, it is a low yield and the risk element with the stock is a bit. So I'm going to go ahead and deselect that one. Triple M, it's still very high over price. So this one could come back down to the middle point before kind of balancing out. You can see here that it has had a steady increase over the last year. Over the last 10 years, you can see that the 2008 recession did not phase us too much. The yield did increase over 4%, nearly over 4.7%, and now it's trading at a 2.03. So this stock could be considered very high. You can also hit the PE ratio in here. You can see it has a PE ratio of 29.23. And there we are. I'm just going to go ahead and remove that one for now. I'm not going to do a deeper dive into Triple M. While Triple M is a great stock, it does look a little bit overpriced at this current time. And I would not recommend taking, it's a recommendation. Risk is always an element there. Oh, you know what? I'm in the 10 years. So, of course, I'm not going to find a price over yield in 10 years. So, let me bring back Triple M and UTX. And let's take a quick look at these again. I was looking at them over the last 10 years. So, okay, it's still looking at it over the 1 year here. 1 year or here at the top. The price is still over the yield. So I'm going to go ahead and remove Triple M, UTX, price over yield. Johnson & Johnson, yield over price. So it could be, taking a look at. This could be a good buy. It's not overvalued. It's not undervalued for the year. The yield is currently trading about average. Its 1 year average is right about centered right now. Bank of Hawaii, yield over price. WW Grainger, price over yield. WTR, yield over price. Target has a price over yield. This is really uncommon. Back in 2017, you could buy Target way down in the $50 range, and people were saying, "Oh no, not a great buy. Retail's going down. Amazon's going to be taking them out in the next couple of years. Amazon's buying up wholesale. What are they going to buy up next?" Target deep dive during these times where Amazon announced that they're doing specific stuff, and those are great opportunities to buy Target. I know a lot of investors that picked up a lot of Target, and now look at them. They're trading at $73.25 there. The yield was over 4.5%. Now you're buying it at a 3.34. So I'm going to go ahead and remove that one for now as well. Lockheed Martin, price over yield right now. So we're left with Johnson & Johnson, Bank of Hawaii, and Aqua America. Now some of the other things I like to take a look at is I'll take a look at their PE ratio. How is their PE in comparison to the S&P 500? The S&P 500 trading right around a 25 price to earnings ratio. So Johnson & Johnson, this stock recently back in January jumped up to a PE ratio of 336. I don't think this is correct. If I go to my PE ratio, oops, there we go. Whoops. It's funny that it picked up Johnson & Johnson right away there. So here I can see Johnson & Johnson's real PE ratio is at a 22.9. The industry average is at a 26.5. The S&P average right now is at a 24 because it did come down. So Johnson & Johnson, it's slightly under the S&P 500 and it is underneath the industry average. And then the average 5-year for Johnson & Johnson is at a 20.5, so it is trading a little bit over the 5-year average. So this one I would not worry too much about. Sometimes you'll see these spikes, and that's why I always go over and use Morningstar.com, financial.morningstar. They have great information, kind of like doing price to book, earnings, sales, cash flow. You can see their cash flow over the last 5 years average. I like to see these numbers. You can see that their Johnson & Johnson yield, it's currently trading at a 2.5, whereas their 5-year average is at a 2.7. So next thing I like to take a look at is their revenue, free cash flow, and net income. I like to take a look at this over the last 10 years. Are they moving positive? So Johnson & Johnson, their net income has been going down. So I don't know if this is just like a bad quarter that they announced, or if the numbers that Y-Charts is receiving is incorrect, because again, they rated their PE ratio at high. So I don't consider their net income. That may not be the correct numbers, so that would definitely be something I would look back over their last quarter, because I'm pretty sure that they may have announced recently. So I would definitely look over the last quarter, the 10Q or the 8Q, 10Q, and then take a look over the last 5 years of 10Ks. So here they do have increasing free cash flow, increasing revenue. I don't trust their net income. Bank of Hawaii here, they do have increasing free cash flow. In a time where most companies have had very nice revenues and net income, Bank of Hawaii has came down over the last 10 years. Since the recession period, they haven't fully recovered. If we take a look at their price, they did recover very quickly from the crash. It took about 3 years for them to fully recover back to where they had originally lost their price from, and then ever since then they have been up over 10 years, 75.27%. So average over the last over 10 years, their average is around 7.5, which is an amazing. Johnson & Johnson is around 10% per year average, and you can see that this recession barely phased them. And then we have Aqua of America here, taking a minute to load. Let's uncheck it, recheck it, there it goes. And Bank of America, they have remained pretty steady for their price. So let's go ahead and just take a look at what their price looks normal. And they within a year of getting through the market crash in 2008, they quickly recovered just within like the year or less, and then they fell back down again. It looks like had a little bit longer 2-year period here between 09 and 11, and then ever since then just picked it up. And the percentage over the last 10 years has been up 112, which is around an average of 11% per year. So very nice potential there, and just kind of bringing in their revenue and free cash flow and net income. They are pretty steady as far as net income. Their revenue has been increasing pretty steady. Their free cash flow is down, but this Aqua revenue is a utilities company, so I'm sure if you went back through, what's their ticker symbol? Yeah, they're a water utility, so I'm sure if you went back through their 10Ks, you may see that some of their free cash flow was through, they've been using on acquisitions, or take a look at where they've been using their free cash flow. I like to read over the 10Ks over just any other reports, just because they give you the most information year to year, and you can kind of compare the numbers, and then if something sticks out, then you can go over the quarterly ones. And then take a look at, always listen to the last few conference calls to see, what were their plans and what have they been up to quarter to quarter. So over these 3 companies, they have all been pretty resistant to the stock market crash. These all have dividends of increasing, Johnson & Johnson, just a nice steady increase even during recessions. Bank of Hawaii, this one did not fully recover. You can see here it peaked out in 2008 at a little over $55. It did not recover until 2014. So that is nearly a 6-year period where you would have no capital gains. And Bank of Hawaii, did they stop their dividend? BOH. So they cut their dividend. So I would automatically kick out Bank of Hawaii there. It would not be worth it recommending or investing in that company over the long term. Whereas WTR, 10 years of dividend growth, and Johnson & Johnson has had 55 years of dividend growth. For between these two, they're not, neither one would be considered, better than the other. They both have their own strengths. One's a utility company. You can see utility company didn't get phased at all, whereas Johnson & Johnson did come down quite a bit. Now, something you can take a look at here during WTR is you can use the slider here. So this says that they've only had dividend growth for the last 10 years since 2008. Down here we can take a look at what happened in 2008. We can zoom in right here, and we can see that in 2006 they had a stock split. They did a 4 for 3, so for every 4 they would give you 4 for 3. So for every 3 stocks that you held, they would give you 4 of them, and then they did decrease their dividend slightly there during that quarter, then they picked it right back up. Now 2008 is when this one says that they had a dividend cutoff, but you can see here in 2008 they were paying 10 cents, 2009 11 cents, 2012 or 10, 12 cents. They did do a very nice increase. So the charts here, sometimes if they do a stock split, they'll cut their dividend because they're giving you more stocks for what you held, but they're they may have decreased their dividend, but you're holding more shares, so you still get paid out either roughly the same or more. Here they did another stock split, 5 for 4, increased their dividend, and then continued to pay out their dividend, even continuing on the same rate that they were already paying out. So don't always trust your dividend growth here at the top. So this one, even though this says 10 years of dividend growth, they cut, they did a stock split. They gave you 4 for every 3 that you had. They did increase their dividend for just a second and then picked it right back up, and then even did another stock split and increased their dividend, continued their dividend. So that is Dividend.com, and that's how to use both of them at the same time. Great combination to kind of narrow down your choices. So between these two, utility companies could be a very nice buy. Even during this current time frame, you can see here that the stock has came back down, but it's a utility company. It's usually generally very nice and safe to invest in. Have a couple of them in your portfolio. They may come down during some downturns, but they will always pick it back up because they're basically a monopoly, right? So that is it for this video. If you have enjoyed the video and learned something, if you've never checked out Dividend.com or YCharts, go ahead and check them out. Again, YCharts, there is a link in the description below. You guys can check them out. If there's not a link there, let me know in the comments and I will add it there. It's also on my website, the www.financial-investor.com. It's underneath tools, I believe. I don't even know my own website. If you go to resources here, and then underneath resources we have investing tools, and then we have YCharts, and then it automatically loads up, has all my financial metrics that I use it for. So that is it. I have to add the video in there. So that is it for this video. You liked the video, hit the like button. If you're brand new to my channel, hit the subscribe button. I really appreciate it. As always, if you have any questions about anything that was covered today, or just want to say hello, please leave a comment below. I will always reply back to you guys. As a friendly disclaimer, I am not a financial advisor or tax professional. The information provided in my videos is my opinion for entertainment and fun. This is not investment advice. This is just me as a financial investor trying to help others make their money work for them. Thank you guys for tuning in. I will see you next time. Have a great day. Bye-bye.